Cathay Pacific was on the brink in 2019 to 2021 as Hong Kong's hub fell quiet and losses mounted. By 2025, it has swung back to profit, rebuilding its network with fuller planes and stronger premium yields, while a resilient cargo arm continues to underpin results. The turnaround rests on cost resets, tighter capacity discipline, and balance sheet repair, deleveraging and early repayment of pandemic support. Load factors and yields have improved, especially in business and first, lifting revenue quality quarter by quarter. Risks remain: staffing and retention, fiercer Greater Bay Area competition, and geopolitics that can reshape traffic flows. Measured against regional rivals like Singapore Airlines, Cathay now looks battle-hardened, its recovery a test of Hong Kong's renewed role as a regional gateway. To understand the magnitude of Cathay Pacific's 2025 comeback, we must revisit the depths of its crisis. The trouble began in 2019, when Hong Kong's pro-democracy protests erupted. The unrest sharply curbed travel demand to Hong Kong and even embroiled Cathay in controversy. Some staff participated in protests and were later fired under Beijing's pressure, sending morale plummeting. Passenger numbers tumbled in late 2019 as visitors stayed away, denting Cathay's revenue just as storm clouds gathered on the horizon. Then came 2020 and the COVID-19 pandemic, a catastrophe for global aviation. Hong Kong's response was especially strict. Quarantine rules and border closures effectively cut the city off from the world for much of 2020 to 2022. Cathay Pacific, which relied heavily on international and transit traffic via Hong Kong, was virtually grounded. At one point, the airline was operating at under 5% of its pre-pandemic passenger capacity, a stunning collapse. Its modern fleet of long-haul jets sat idle on tarmacs. Photographs showed rows of Cathay Pacific planes parked wing to wing at Hong Kong International Airport. The once proud carrier was hemorrhaging cash, burning through reserves just to stay alive. Financial losses mounted at an unprecedented pace. In 2020 alone, Cathay Pacific posted a devastating loss of 21.6 billion Hong Kong dollars, approximately 2.8 billion US dollars, the largest in its history. The following year remained deep in the red with another multi-billion-dollar loss, around 5.5 billion Hong Kong dollars in 2021. By the end of 2022, after nearly 3 years of draconian travel restrictions, Cathay's cumulative losses due to the pandemic had swollen to roughly 34 billion Hong Kong dollars. To put that in perspective, the airline wiped out years' worth of profits and more in just a short span. It was a financial tailspin that few companies could endure. Cathay Pacific survived only thanks to a major government-led bailout and painful restructuring. In June 2020, as the crisis worsened, the Hong Kong government stepped in with a 39 billion Hong Kong dollar recapitalization package. This included a direct equity injection, a loan facility, and warrants, effectively nationalizing a stake in Cathay to keep it solvent. The bailout gave Cathay a lifeline of cash, but at the cost of diluting shareholders and placing the government as a significant stakeholder, with an eventual 6% stake via preference shares. It was a humbling moment for a once profitable privately run airline. Internally, Cathay undertook drastic measures to slim down. In October 2020, management announced a sweeping restructuring. The airline's entire regional subsidiary, Cathay Dragon, formerly Dragonair, was shuttered overnight, instantly axing its brand and routes. Some 8,500 jobs were cut, roughly a quarter of the group's headcount, in one of Hong Kong's largest mass layoffs ever in aviation. Thousands of cabin crew and pilots were made redundant or asked to accept new lower-paid contracts. Notably, pilots faced pay cuts reportedly up to 40%, prompting many senior captains to leave. This painful reset lowered Cathay's cost base dramatically, though at a cost to staff goodwill. The company also retired older aircraft ahead of schedule, simplifying the fleet for efficiency. Every non-essential expense was slashed. Remaining staff took unpaid leave. Executives took pay reductions. These moves were brutal, but necessary for survival. For nearly 2 years, passenger revenue evaporated. Hong Kong's quarantine rules were so stringent that Cathay's crew had to endure weeks-long hotel isolations after trips, making normal operations impossible. The airline flew a skeleton schedule, often just a handful of daily flights, and at one point in early 2021 carried fewer than 1,000 passengers per day, down from 100,000 plus pre-pandemic. Cargo became Cathay Pacific's lifeline. With a fleet of dedicated freighters and plenty of belly capacity on passenger planes, when they did fly, Cathay pivoted to hauling freight, medical supplies, e-commerce goods, and electronics out of manufacturing hubs in China. Freight yields spiked as global shipping capacity fell, and Cathay's cargo arm generated much-needed cash. In 2021, cargo revenue actually exceeded passenger revenue for the first time in the airline's history. As we'll explore, Cathay Cargo's strong performance during the crisis helped offset some losses and positioned the airline for the recovery ahead. By late 2021 and into 2022, the situation slowly improved. Vaccines rolled out and global travel began to rebound, but Hong Kong's reopening lagged far behind. While airlines in North America and Europe started profitable rebounds in 2022, Cathay was still effectively grounded by Hong Kong's mandatory quarantines and travel bans. The city finally began easing restrictions in late 2022. By early 2023, quarantine for arrivals was scrapped, and Cathay Pacific could start rebuilding. The airline embarked on a 2-year rebuild journey through 2023 to 2024, as described by its management. Planes were brought out of storage, routes were resumed, and thousands of staff were hired or rehired to handle rising operations. The financial results reflected this nascent recovery. Cathay Pacific managed to return to profitability in 2023, reporting a net profit of 9.78 billion Hong Kong dollars for the year, its first annual profit in 4 years. It came on the back of a strong cargo market and rapidly returning passenger demand in late 2023 when Hong Kong finally lifted travel curbs. Then, in 2024, with a full year of unrestricted flying, Cathay sustained that recovery with a 9.9 billion Hong Kong dollar profit, roughly 1.27 billion US dollars. The airline declared dividends again and even initiated steps to repay the government bailout. By mid-2024, Cathay had redeemed all 19.5 billion Hong Kong dollars in preference shares issued to the government, buying back the remaining 9.75 billion Hong Kong dollars in July 2024, and also repurchased the associated warrants. In short, by 2024, Cathay Pacific had financially righted the ship, emerging from the storm smaller but intact. This sets the stage for 2025, a year in which Cathay aims not just to survive, but to thrive. The crisis years forced the airline to transform, cutting costs and refocusing its business. Now, with Hong Kong's borders open and global travel roaring back, Cathay Pacific is leveraging its leaner structure to capitalize on resurgent demand. The turnaround we witness in 2025 is built on the ashes of those painful years. Cathay's management likes to say the airline is more resilient than ever before after the challenges it overcame. In the next sections, we'll see how that resilience translates into the numbers, how Cathay Pacific's revenues, traffic and profits have rebounded in 2025, signaling one of the industry's most impressive post-pandemic comebacks. Cathay Pacific entered 2025 with serious momentum. Having completed its rebuild phase by restoring 100% of its pre-pandemic flight schedule in January 2025, the airline was poised to start growing again. The big question was whether passenger demand, especially for lucrative long-haul routes, would return at the same pace. The financial statements from 2025 show a reassuring story. Cathay Pacific Group's revenues have surged as travelers flood back into planes, even if ticket yields have moderated from their 2022 highs. Let's break down the revenue rebound, quarter by quarter, based on official disclosures up to Q3 2025. First half 2025. Cathay Pacific reported 54.3 billion Hong Kong dollars in total revenue for the first 6 months of 2025, a 9.5% increase year-on-year. This growth came on top of an already strong first half in 2024, which itself had seen a big jump from near-zero 2021 levels. Importantly, the revenue mix in H1 2025 marked a return to a passenger-centric business. Passenger operations contributed the majority, while cargo maintained a significant share. More on cargo shortly. Cathay Pacific's mainline passenger revenue for H1 2025 was 34.208 billion Hong Kong dollars, up 14.0% from H1 2024. This double-digit growth was achieved despite passenger yield, revenue per kilometre, actually falling year-on-year, a key trend we'll discuss. Essentially, higher volume more than made up for lower fares. The capacity ramp-up was dramatic. In the first half of 2025, Cathay's available seat kilometres, ASKs, a measure of passenger capacity, jumped 26.3% compared to H1 2024. Traffic measured in revenue passenger kilometres, RPKs, grew even faster, up 30.0%. In plane terms, Cathay carried a lot more passengers, and planes were fuller on average than the year before. The airline transported 13.6 million passengers in H1 2025, about 75,300 per day, which was 27.8% higher than the same period in 2024. By June 2025, load factor, the percentage of seats filled, had risen to 84.8%, up from 82.4% in H1 2024. An 84.8% load factor is quite robust, indicating most flights were near capacity. It's also on par with or better than pre-pandemic averages for Cathay, reflecting that demand recovery was in full swing. However, the flip side of ramping up capacity was that yields fell from extraordinary post-pandemic levels. During 2022 to 2023, airfares globally had spiked due to limited flights and high demand. By 2025, competition in Asia was intensifying as airlines restored routes. Cathay's average passenger yield in H1 2025 dropped 12.3% year-on-year to 0.604 Hong Kong dollars per passenger kilometre. This was expected. In fact, Cathay's CFO noted that regional airfares are back to normal, and long-haul fares were trending down as more seats returned to the market. So, Cathay's revenue growth came from carrying more passengers, not from charging higher prices. The good news is that the volume growth comfortably offset the yield decline, resulting in higher total passenger revenue. We will explore in the next section how premium cabin demand factored into this balance, because strong business and first-class traffic helped buoy Cathay's average revenue per flight even as economy fares softened. Quarterly momentum in Q3 2025 also underscored the recovery. While Cathay, like many Asian carriers, does not publish detailed quarterly profit figures outside of half-year and full-year reports, the company does release monthly operating statistics that give insight into Q3. These show that July, August, and September 2025 each saw 20 to 30% year-on-year increases in passenger traffic for Cathay Pacific mainline. For instance, in July 2025, Cathay Pacific carried 2.49 million passengers, up 24% versus July 2024, and the monthly passenger load factor hit 86%, one of the highest in recent memory. August 2025 was even stronger in absolute volumes. Cathay Pacific carried roughly 2.7 million passengers that month, a 30% jump year-on-year. Across Cathay Pacific and its budget arm HK Express, the group averaged 110,000 passengers per day in August 2025, the first time breaking the 100,000 per day mark since the pandemic and approaching pre-2019 peak levels. By September 2025, as the summer travel rush subsided, growth was a bit more moderate, but still significant. Cathay Pacific carried about 2.2 million passengers in September, 21% more than a year prior. The group, Cathay plus HK Express, carried over 2.7 million that month. Notably, Cathay reported that in the first 9 months of 2025, cumulative passenger numbers were 27% higher than January to September 2024, a clear sign of sustained recovery. Financially, this translated into strong revenue upticks in Q3, which will be part of the full year 2025 results. Although we don't have Q3 standalone revenue published, the trend of approximately 10 to 15% revenue growth seen in H1 likely continued or even accelerated slightly into the third quarter, given the summer peak. It's reasonable to expect the Cathay Pacific Group's revenue for full year 2025 will land somewhere around 110 to 115 billion Hong Kong dollars, which would surpass 2019's revenue and even slightly exceed 2024's 104.4 billion Hong Kong dollars. Achieving or exceeding pre-pandemic revenue in 2025 would be a milestone, considering the fleet and network are still rebuilding. What were the drivers of this revenue resurgence in 2025? 3 stand out: volume rebound in premium travel, the return of high-yield travelers, business people, professionals, and affluent leisure flyers, especially on long-haul routes, boosted revenue disproportionately. We'll discuss soon how business and first-class cabins saw occupancy surge to new highs in 2025 as events and corporate travel resumed. Long-haul network restoration: Cathay Pacific reopened routes and added new destinations at a rapid clip. By mid-2025, the group served over 100 destinations worldwide again, including long-haul markets like Europe and North America, which are crucial for revenue. For example, Cathay resumed flights to cities like Chicago, Washington, D.C., Brisbane, and added new routes such as Hong Kong-Rome, June 2025, and Hong Kong-Brussels, August 2025. These flights often had high load factors. The relaunched Brussels route achieved over 85% full in August and contributed significantly to RPK growth. Stable cargo contributions. While passenger revenue soared, cargo revenue remained robust, providing a second pillar of income. In the first half of 2025, Cathay's cargo revenue actually increased slightly, 2.2% up, to 11.14 billion Hong Kong dollars, despite global freight rates softening. Cargo has historically high yield per unit and remained a larger share of Cathay's business than before the pandemic. The continued strength in freight helped ensure the group's total revenue growth didn't rely solely on passenger performance. Taken together, these factors allowed Cathay Pacific to rapidly rebuild its top line in 2025. The airline's ability to capture pent-up travel demand is evident in the numbers. After a harrowing collapse in 2020 to 2021, Cathay's revenue engine is roaring again. Yet it's not just raw revenue that tells the story. Equally important is what kind of revenue. Next, we examine how the quality of Cathay's revenue mix improved in 2025, focusing on passenger load factors, unit revenues, RASK, and the all-important premium cabin traffic that makes an outsized contribution to the bottom line. Cathay Pacific's passenger recovery in 2025 has been characterized not just by more people flying, but by smart gains in the metrics that really matter for profitability. How full the planes are, load factor. How much revenue each seat is generating, RASK, revenue per available seat, kilometer. And the mix of cabins those passengers are choosing, economy versus premium. In this section, we'll explore how higher load factors and a resurgence in business and first-class travel have turbocharged Cathay's turnaround, even as average fares moderate. Firstly, the load factors Cathay is achieving in 2025 are impressive and significantly above the crisis years. As noted, the mainline airline's passenger load factor hit 84.8% in H1 and hovered in the mid-80s through the summer. For context, an 85% load factor is higher than Cathay's annual average in 2018 to 2019, which was around 82 to 83%. It indicates a tight supply-demand balance. On many flights, especially long hauls, seats are essentially all sold. In July 2025, load factor reached 86%. By September 2025, Cathay revealed that premium cabins, business and first, had their highest load factor of any month so far that year. This is a crucial point. High premium cabin loads suggest a robust return of business travelers and high-end leisure travelers. During the pandemic recovery, one lingering worry for airlines was whether business travel would ever fully return, given the shift to virtual meetings. By late 2024 and 2025, Cathay's experience suggests that while corporate travel patterns have evolved, demand for premium air travel is very much alive. In December 2024, Cathay noted a surge in business-related travel in premium cabins before the holidays. That trend continued into 2025. The Skytrax Awards even ranked Cathay Pacific as one of the world's top 3 airlines in 2025 and lauded its premium services, best economy class and top 3 business class, reinforcing that Cathay has doubled down on being a top-tier premium carrier, which attracts those high-yield customers. Higher premium occupancy had a direct effect on RASK, revenue per ASK. Even though economy yields fell, filling more business and first seats lifts the average revenue per flight significantly, because those seats cost many times more than economy. One specific metric underlines the improving economics: passenger revenue per ASK, PRASK. In H1 2025, Cathay's passenger yield per RPK fell 12%, but because load factors rose and more seats were deployed on long routes, the overall PRASK likely fell less than that, or potentially held steadier. Meanwhile, Cathay's cost per ASK, CASK, was coming down. We'll discuss costs later. When RASK stays above CASK, the airline is in profitable territory. By mid-2025, Cathay was indeed profitable, indicating it had reached that crossover. The resurgence of premium travel is perhaps best encapsulated by HK Express's contrasting performance. Cathay's low-cost subsidiary, HK Express, saw its passenger numbers boom in 2025, up 33% in H1, 32% in first 9 months. But HK Express's yields plunged approximately 27%, and it actually made a loss in H1 2025. This shows that the lower end of the market was saturated with competitive fares, hurting profitability. Cathay Pacific Mainline, however, benefited from servicing the higher yield market segments: long-haul travelers, transit connectors, and premium flyers. Where the budget carrier slashed fares to fill seats, Cathay Mainline could rely on brand loyalty and premium perks to maintain a fare premium. Indeed, Group CEO Ronald Lam stated Cathay's goal is to become the world's best premium airline, a positioning aimed at capturing discerning customers willing to pay more. The ultimate proof of Cathay Pacific's recovery is its return to sustained profitability. In 2025, the airline is not just generating revenue, it's converting that revenue into healthy profits, thanks to a combination of strong demand and rigorous cost control. Let's look at Cathay's profit metrics, margin recovery, and how those compare to regional competitors. We'll also discuss how analysts view Cathay's trajectory and what expectations are for its financial performance going forward. Cathay Pacific already signaled its resurgence with the 9.9 billion Hong Kong dollars net profit in 2024, which was actually slightly above the 2018 pre-crisis profit and marked the second straight profitable year. In 2025, Cathay has continued that trend. For the first half of 2025, Cathay Pacific Group reported a net profit of 3.7 billion Hong Kong dollars. This was virtually the same as H1 2024's profit, 3.65 billion Hong Kong dollars, indicating that despite lower yields, careful cost management and higher passenger volumes kept earnings steady. Importantly, Cathay was confident enough in this result to declare an interim dividend of 0.20 Hong Kong dollars per share, 1.3 billion Hong Kong dollars payout, in August 2025, matching the dividend paid after H1 2024. Resuming dividends is a strong sign that management views the recovery as durable. It's worth noting that paying dividends and buying back government shares in 2024 to 25 was only possible because Cathay had rebuilt a solid profit base. Looking at operating profit and margin, Cathay's underlying performance has improved dramatically from the loss-making years. While exact operating margin for 2025 isn't published yet, we can glean some figures. In the first half of 2025, the group's operating income, before tax and exceptional items, is 5.9 billion Hong Kong dollars, given the net profit of 3.7 billion Hong Kong dollars. Cathay has tax losses carried forward, so tax expense is low. That would equate to an operating margin around 10% for H1. Traditionally, the second half, H2, is stronger due to seasonality, summer and year-end, peak travel. So Cathay's full-year 2025 operating margin would end up around 10%. This would be a remarkable turnaround from 2020 to 2021, when margins were deeply negative. It also compares favorably to the roughly 9.5% net margin Cathay achieved in 2024 9.9 billion Hong Kong dollars profit on 104.4 billion Hong Kong dollars revenue. How does Cathay's profitability stack up against regional peers? Let's consider Singapore Airlines, SIA, often seen as Cathay's main competitor in the premium Asian airline space. SIA had a head start in recovery. Singapore reopened earlier and achieved record profits. For its fiscal year 2024/25, ended March 2025, SIA Group reported a net profit of 2.78 billion Singapore dollars, roughly 16 billion Hong Kong dollars, which was indeed a record for them. That net profit margin was about 14% on record revenue. In calendar 2024, SIA's profit was around 2.0 billion US dollars, making it one of the world's most profitable airlines post-COVID. By comparison, Cathay's profit $1.27 billion US dollars in 2024 is a bit lower in absolute terms, but Cathay was catching up fast in 2025. Hong Kong's late reopening meant Cathay's big profit jump will likely manifest over 2024 to 2025, whereas SIA had its leap in 2022 to 23. Another peer, the Chinese airlines, Air China, China Southern, etc., remained less profitable or even loss-making in early 2023, but are improving in 2025. Taiwan's EVA Air and China Airlines returned to profitability by 2023 as well. Korean Air had a huge cargo-driven profit in 2021 to 2022 and remains profitable. Japan's ANA and JAL returned to profit by 2023, though with thinner margins due to domestic market reliance. In Southeast Asia, Thai Airways is restructuring. Malaysia Airlines is smaller now. Garuda Indonesia restructured. Qantas in Australia had a record profit in its fiscal 2023, but has hit some cost turbulence in 2024. Overall, Cathay's margin by 2025 is respectable, but not yet the very highest. SIA holds that crown for now. However, Cathay's margin trajectory is upward. One could argue Cathay has more room to improve because it is still ramping capacity into mainland China, a lucrative market, and hasn't fully normalized its network until perhaps 2025. Analysts are watching Cathay's margins to see if they can close the gap with SIA. Notably, Cathay's cost base is higher in Hong Kong, fuel is imported, staff costs are high, and Cathay's fleet historically had 4-engine jumbos which are less efficient, though those are mostly gone now. On the other hand, Cathay benefits from an advantageous geographic hub, closer to mainland China flows, and now a leaner operation after its restructuring. Speaking of costs, a huge part of Cathay's profit recovery story is cost discipline. Through the rebuild, Cathay kept a tight rein on expenses even as it ramped up flying. We have concrete data on this. In the first half of 2025, non-fuel costs for Cathay Pacific Group rose 14.9% year-over-year, significantly slower than the 26% increase in ASKs. That implies unit cost, ex-fuel, dropped notably. In fact, Cathay reported that its cost per ATK, available ton-kilometre, excluding fuel, fell by 0.9% in H1 2025. Including fuel, cost per ATK fell 4.1%, helped by lower fuel prices. These are impressive achievements. The airline managed to reduce unit costs while expanding capacity, showing that the scale efficiencies and permanent cost cuts are kicking in. One specific profitability metric to highlight is operating margin versus pre-pandemic. In 2019, Cathay's operating margin was only approximately 5%. It had some struggles even then due to the protest impact and competition. The restructuring and pandemic reset have arguably made Cathay a more efficient company than it was in 2019. If it achieves approximately 10% margin in 2025, that would be double the 2019 level, indicating a structurally improved business. This is something that was seen with many US airlines post-Chapter 11 restructurings. They emerged leaner and more profitable. Cathay's leadership has essentially used the crisis to remake the airline's cost structure for the better. In comparing to other peers, Cathay versus Chinese Big Three, Air China, China Eastern, China Southern, those carriers had massive losses during China's lockdown and only turned profitable in mid-2023. Their domestic focus gave them an early revenue boost in 2023, but international yields are now lower for them and they have less cargo exposure. Cathay's nimbleness and premium brand allowed it to rebound faster financially than the lumbering state-owned mainland airlines. Cathay versus Middle East carriers, Emirates, Qatar Airways, etc., which are also premium and cargo-heavy. Emirates had record profits in fiscal year 2022/23, thanks to cargo and pent-up demand. Cathay's geography means it doesn't compete head-to-head as much with them, except on certain routes, e.g., HK to Europe flows. But it's noteworthy that the Middle East giants restored capacity quickly and yields dropped. Cathay's caution in capacity deployment might have preserved margin better on some connecting flows. All told, Cathay Pacific's profitability in 2025 looks solid and sustainable. The airline has regained an even keel. It is earning strong operating profits, paying dividends, and investing in its future, like new aircraft orders of over 100 billion Hong Kong dollars. Its margin is competitive, if not best in class, and the company has proven that it can adapt and thrive in the new normal of Asian aviation. The positive comparison to peers and the beating of analyst forecasts have also buoyed investor confidence. Cathay's stock price in 2025 recovered significantly from its 2020 lows, reflecting renewed optimism. However, sustaining profitability will also depend on continued cost discipline. Cathay can't control fuel prices or global economics, but it can control its own efficiency. The restructuring benefits are mostly baked in by now. From here, margin expansion would have to come from either further unit cost reduction, e.g., by using larger aircraft, technology improvements, etc., or yield, product improvements, like upselling premium economy, ancillary revenue, etc. The airline has signaled it is focused on both, continuing a cost-conscious culture internally, while also rolling out product upgrades, like the new Aria Business Class suites and upcoming 777-9 First Class, to reinforce its premium edge. That combination should help protect margins even as competition intensifies.